Ladies and gentlemen, we need to stop staring at charts for a moment. Forget the RSI, the moving averages, and the colorful lines on your screen. What matters right now is the clock. Today is Tuesday, December 30th, 2025. Remember that date, because we are exactly 48 hours away from the most important structural shift in the global silver market. Not in New York, not on Wall Street, but in Beijing. We are 48 hours away from the January 1st China export ban. And if you think markets wait for official announcements to panic, you don't understand how the system works. Banks never wait for press releases. They move early, they move quietly. And that panic has already started. And what we witnessed this morning was not normal volatility. It was not profit-taking. It was not random price action. It was a coordinated systemic seizure, a moment that exposed how little time the Western paper system has left, and how little metal the Eastern physical system has remaining. Two tectonic plates are colliding in real time. At exactly 8:15 a.m. Eastern Standard Time, something critical happened. While most people were making coffee, the Federal Reserve quietly injected emergency liquidity. No press conference, no warning, just cash flooding into the banking system. At the exact same minute on the other side of the planet, something else happened. The Shanghai Gold Exchange recorded one of the largest physical silver withdrawals in history. The United States printed money to protect paper markets. China removed metal to protect reality. Both actions happened on the same morning, just 2 days before the supply chain locks shut. That is not a coincidence. In finance, there are no coincidences. There is leverage, and there is the breaking of leverage. What we heard today was the sound of stress fractures spreading. The paper price is separating from physical truth. And the divorce papers were filed this morning. In New York, the paper system is cracking. Derivatives, leverage, and promises required a $3 billion emergency patch before the market even opened. That is not normal. That is triage. In Shanghai, the physical system is evacuating. Silver is being removed, not traded, loaded onto trucks and locked away. This is not speculation. This is hoarding. This is what a real squeeze looks like. A squeeze is not a line going up on a chart. A squeeze is when paper claims collide with physical scarcity, and that collision began today at 8:15 a.m. If you are holding silver, do not let volatility scare you. Do not let headlines shake you out. Prices are being smashed because control is slipping. Manipulation is happening because fear is rising. The alarms are sounding in the repo markets. The vaults are emptying in Asia. In the next section, I will connect the dots. A $3 billion Fed injection. A 41-ton silver withdrawal. Two sides of the same event. One side fighting with liquidity, the other side fighting with gravity. And gravity always wins. It is a death spiral for paper silver shorts, and the clock is ticking. Tick-tock, 48 hours remain. Every passing hour moves us closer to the moment China shuts the gates. Every passing hour makes physical silver inside vaults more valuable. Every passing hour turns paper contracts in New York more dangerous. This is why this is an emergency alert. This is not normal market behavior. The data today shows a system entering structural failure. The gap between suppressed paper prices and exploding physical demand cannot survive much longer. It may not even survive the next 48 hours. If you are asking why prices are violent today, stop guessing. You are hearing a financial war in real time. You are hearing the Federal Reserve throw $3 billion at a problem money cannot solve. You can print dollars, you can print euros, you can print yen, you cannot print silver. 41 tons of silver just left Shanghai. That metal is gone permanently. It has moved east while the West holds freshly printed paper. Those dollars are now chasing fewer real assets. We are about to break down exactly how this happened. You need to understand why this liquidity injection signals weakness, not strength. You need to know who took that silver and why it matters. Most importantly, you need to understand you are watching history form. December 30th, 2025 may be remembered as the day the illusion cracked, the day the paper market needed life support, the day physical silver walked out the door. And let's examine the $3 billion injection, because where that money went reveals how close the system is to collapse. This brings us to the repo market panic, and to the question mainstream media refuses to ask: why did the Federal Reserve emergency print $3 billion at 8:15 a.m. on a Tuesday? In a healthy system, banks lend to each other easily. Cash moves overnight without fear. Collateral is trusted. The repo market stays quiet, but this morning, the repo market screamed. At exactly 8:15 a.m., demand for overnight liquidity exploded. A major entity demanded $3 billion immediately. Without it, they could not open for business. That is financial cardiac arrest. When a bank goes to the Fed for emergency repo, the private market has rejected them. It means other banks refused their collateral. It means trust vanished overnight. So they ran to the lender of last resort. Now look at the breakdown. $2 billion was exchanged for U.S. Treasuries. $1 billion was exchanged for mortgage-backed securities. This matters because it signals forced liquidation. Someone needed cash immediately. They were raising capital under pressure. You raise capital like this for one reason, a margin call. Now silver enters the picture. The timing is not coincidence. This liquidity panic hit as silver volatility surged. Major banks are holding massive short positions in silver derivatives. As prices rise, collateral requirements explode. When volatility spikes, clearinghouses demand instant cash, fail to deliver, and positions are liquidated. Here's the scenario the data supports. A major silver derivatives player woke up exposed. They saw Shanghai draining metal. They saw pre-market price pressure. The clearinghouse demanded $3 billion immediately. They did not have the liquidity. Other banks refused to lend. Risk was obvious. Blood was in the water. So they ran to the Fed. The Fed stepped in to prevent systemic failure. This was not stimulus. This was not economic support. This was a targeted bailout. It patched a derivatives leak threatening the plumbing of the entire system. It proves silver leverage has become systemic risk. A single morning of volatility forced central bank intervention. Think about that. Without this injection, default was minutes away. Liquidation would have followed. Silver would have gapped toward triple digits instantly. The only thing holding prices down is money printing. But here's the paradox. This bailout is bullish. The Fed can fix liquidity. It cannot fix insolvency. It cannot fix physical shortages. No silver was printed today. No vaults were refilled. Only paper swapped for paper. That is not resolution. That is delay. Now look at the mortgage-backed securities. Those assets are less liquid, harder to sell. The fact the Fed accepted them shows desperation. The borrower was scraping the bottom of the barrel. This was not strategic. It was survival. And someone noticed. China noticed. They saw the repo spike. They saw stress in U.S. banking. They did not offer help. They accelerated the endgame. While the West scrambled for paper, China moved for metal. They understood something critical. If banks are this stressed before supply shuts off, collapse is inevitable once it does. So they front-ran the collapse. The $3 billion injection is the tell. In poker, a tell reveals the hand. The Fed blinked. They showed they will print off-cycle to keep the game alive one more day. But one more day is all they have? Because while New York fixed plumbing with paper, Shanghai turned on the vacuum. That vacuum does not accept dollars. It does not accept treasuries. It does not accept mortgage bonds. It only accepts metal. This is the cost of the lie, not stability. It took $3 billion just to survive one morning. The question now is how much tomorrow will cost, and how much January 1st will cost. The price of deception is rising exponentially. Physical silver supply is collapsing vertically. Now the focus shifts from paper panic to physical aggression, because the real battle is happening in the vaults. $3 billion is nothing compared to 41 tons of metal disappearing. This was not trading. This was war preparation. While the Fed printed paper, Shanghai moved metal. At 9 a.m. local time, the vacuum was turned on. 41 tons of silver were withdrawn in one morning. That is over 1.3 million troy ounces gone instantly. This was not a transfer on paper. This was armored trucks loading real bars. And once that metal left, it was gone forever. The timing tells you everything. January 1st is 48 hours away. New export and licensing rules are about to lock the doors. So Chinese industry is front-running the shutdown. They are hoarding before access disappears. This is panic buying at a state scale. After the withdrawal, Shanghai inventory fell to 755 tons. That number sounds large until you understand demand. China consumes thousands of tons per year. 755 tons is weeks, not months. The buffer is gone. The exchange is running on fumes. This is why the premium is exploding. New York says $75. Shanghai is paying over $80. That $5 gap should not exist. In a free market, arbitrage would close it. But the metal cannot move. The flow is broken. The West sells paper promises. The East takes delivery. That 41-ton withdrawal is a vote of no confidence. China knows the screen price is fake. They are paying whatever it takes to secure supply. The timing is not coincidence. The Fed blinked at 8:15 a.m. China struck 45 minutes later. They smelled weakness. They twisted the knife. The Fed fights fire with paper. China pours gasoline with physical demand. Caught in the middle is the short seller. No metal, no cash, no escape. This is why the panic has already started. You do not remove 41 tons for inventory management. You do it because you are scared. Scared of shortages. Scared of currency risk. Scared of regulation. Inventory at 755 tons means no safety net. One more large order could empty the vaults. A Shanghai delivery failure would end the paper market overnight. A $5 premium would become $50. Now we expose the fraud completely. Because while China moved bars, New York traded fantasies. The volume numbers prove it. On December 30th, COMEX traded 276,000 contracts. Each contract equals 5,000 ounces. That is 1.38 billion ounces traded in one day. Paper silver traded at a level the planet cannot supply. This is not a market, it is a casino, and it is about to burn down. It took the real asset, not paper promises. It took the one thing with zero counterparty risk. It took 41 tons of silver that will never return to the West. So do not see the $3 billion injection as stability. See it as the price of maintaining a lie. It cost them $3 billion just to survive one morning. Ask yourself how much it will cost tomorrow. Ask yourself how much it will cost on January 1st. The cost of the illusion is rising exponentially. The supply of real silver is collapsing vertically. Now we shift focus to the other side of the trade. We've seen the paper panic. Now comes the physical aggression. We need to understand what happened in Shanghai, because $3 billion is nothing compared to what vanished there. This was not trading. This was preparation for war. While the Fed printed paper to plug leaks, the real story unfolded in Shanghai's loading docks. The Fed trades credit. China trades metal. At 9:00 a.m. local time, just 45 minutes after the U.S. panic, China executed a vacuum operation. SGE warehouse data confirms it. 41 tons of silver were withdrawn in a single morning. That is over 1.3 million ounces. Enough for millions of solar panels. Enough for military-grade systems. This was not inventory shuffling. This was physical loadout. Armored trucks removed bullion permanently. That metal is gone forever. So why the urgency? Why a random Tuesday in December? Because January 1st is coming. Because export controls activate in 48 hours. Because silver movement inside China will soon tighten. Smart money is front-running the lockdown. Battery makers, solar giants, and state planners moved first. They cleaned the floor before the doors closed. This single withdrawal crushed Shanghai inventories. Registered silver fell to just 755 tons. That sounds large until you realize China burns thousands yearly. This is a historic danger zone. Only weeks of supply remain. One more major withdrawal breaks the exchange, and when exchanges break, prices explode. That's why Shanghai premiums are blowing out. While New York smashes paper prices to $75, Shanghai trades above $80. A $5 arbitrage should not exist. In a free market, it would vanish instantly, but the metal is trapped. The flow is one-directional. Paper goes west, metal goes east. Chinese buyers are laughing at $75. They know it's fake. They'll pay any price to secure bars now. This is panic buying by a superpower. This is hoarding before regulation, and the timing is the smoking gun. Fed weakness appeared at 8:15 a.m. China struck immediately after. They saw stress in U.S. banking. They escalated the physical squeeze. This is a pincer attack. The Fed fights paper fires. China fuels physical shortages. In the middle sits the short seller. No metal, no cash. That is why panic has already begun. Nobody removes 41 tons casually. They remove it because they are afraid. Afraid of shortages, afraid of currencies, afraid of what comes next. Shanghai inventory at 755 tons means no buffer remains. One shock clears the shelves. If Shanghai defaults, the $5 premium becomes $50 overnight. New York becomes irrelevant. We've seen Fed panic, we've seen Chinese hoarding. Now comes the final exposure, the paper fraud itself. Next, we compare paper volume to physical delivery, and the numbers prove the system is a casino. This is a death spiral for paper silver shorts, and the clock is ticking. 48 hours remain, and every passing hour increases the value of physical silver. Every passing hour makes paper contracts more dangerous and unstable. This is not normal market behavior. This is an emergency alert. The data shows a system entering its final fracture stage. The gap between paper price suppression and physical metal outflow cannot survive. It may not last another week. It may not even last another 48 hours. Today's volatility is not confusion. It is the sound of a financial war. It is the sound of the Federal Reserve throwing $3 billion at a problem money cannot fix. You can print dollars, euros, and yen. You cannot print silver. 41 tons of silver just left Shanghai. That metal's gone forever. The East captured the real asset. The West is left holding freshly printed paper dollars. Those dollars are chasing a shrinking pool of real assets. This is why the Fed's liquidity injection is a sign of weakness, not strength. It did not solve the real problem. It only delayed collapse. At 8:15 a.m., the Federal Reserve executed an emergency $3 billion repo injection. This happened because a major entity could not open for business without cash. Private banks refused to lend. Collateral was no longer trusted. This is what financial cardiac arrest looks like. The Fed stepped in as lender of last resort. That alone signals deep systemic stress. $2 billion was swapped for U.S. Treasuries. $1 billion was swapped for mortgage-backed securities. This tells us someone was liquidating high-quality assets urgently. That means a margin call. The timing aligns perfectly with silver volatility. Commercial banks hold massive short positions in silver. Rising volatility forces them to post more collateral. If they fail, they default. This liquidity injection prevented a derivatives failure. It was not stimulus, it was a bailout. While the Fed printed paper, China took metal. At 9 a.m., 41 tons of silver were withdrawn from Shanghai vaults. This was not a transfer. This was loadout. Armored trucks removed real silver from circulation. That metal is now unreachable by Western markets. 41 tons equals over 1.3 million ounces. This silver will not return. This withdrawal happened for one reason. China is preparing for the export ban. Licensing rules are tightening control over silver flows. Industrial giants are front-running regulation. They are securing supply before the doors close. This is hoarding. This is fear. Shanghai silver inventories dropped to 755 tons. That level represents only weeks of industrial demand. The buffer is gone. Another large withdrawal could break the exchange. When exchanges run on fumes, prices explode. Paper silver in New York was smashed to $75. Physical silver in Shanghai traded above $80. A $5 spread now exists. This arbitrage should not exist in a functioning market. It exists because metal cannot move freely anymore. Paper is trapped. Physical is gone. Chinese buyers are ignoring the paper price. They are paying premiums for certainty. They want metal, not promises. A futures contract cannot power a solar panel. Only atoms can. On the same day, COMEX traded 276,000 silver contracts. That equals over 1.38 billion paper ounces. Nearly 2 years of global mine supply traded in hours. Only 69 contracts resulted in physical delivery. That equals 345,000 ounces. The leverage ratio is 4,000 to 1. This is not a market. This is a fractional reserve fraud. Paper volume exists to suppress price. Physical volume reveals truth. Shanghai rejected the paper price. The market is splitting in two. Later that day, Shanghai raised margin requirements. This move crushed leveraged paper players. It locked out Western arbitrage. Only fully funded buyers remain. This was strategic. This was coordinated. The sequence matters. Fed panic came first. China drained metal second. Shanghai locked leverage third. This was not coincidence. This was siege warfare. The Fed printed to save banks. China hoarded to save industry. Paper markets are being strangled from both sides. January 1st is the deadline. The export ban changes everything. Expect extreme volatility. Expect one last paper smash. Expect fear-based selling attempts. The data matters more than price. 41 tons left the vault. The Fed blinked. Inventory collapsed. The lie is getting expensive. Paper silver is dying. Physical silver is taking control. If you don't hold it, you don't own it. Counterparty risk is now visible. The transfer of wealth is happening in real time. The Fed printed money. China took metal. Which side are you on?